Hey everyone, and welcome. We're about to dive deep into something that sounds kind of complicated, but is actually the heart and soul of any company: share capital. Now I know the term itself can be a little intimidating, but trust me, it's not that scary. Think of it as the engine that powers a business, pushing it forward. By the time we're done here, you're going to get it completely. So let's jump right in. Okay, so picture this. You've got an idea, not just any idea, a $1 billion, world-changing idea. But you need cash, a lot of cash, more than you can get from your savings or a bank loan. So what do? How on earth do you get thousands or even millions of people to chip in and fund your dream? Well, this exact problem led to one of the most brilliant inventions in the entire history of business. And the solution to that huge question? It's the company. Yep, the modern company. It's this incredible invention, a legal structure designed for one main purpose: to bring together money from tons of different people, all working towards one big goal. But here's where it gets a little weird, and honestly, pretty cool. Check out this quote from Chief Justice Marshall. He called a company an artificial person. Think about that. It's invisible, you can't touch it, but in the eyes of the law, it's a person. This legal person can buy buildings, sign contracts, and yeah, it can even get sued, all by itself. And that right there is the absolute key. A company is a separate legal thing, totally distinct from the people who own it, the shareholders. Why does this matter so much? Because it means the company has its own life. It can keep going long after its founders are gone. And for what we're talking about today, it means it can raise money from tons of people. And those people aren't personally responsible if the company gets into debt. That's a game changer. Okay, so if a company is this big artificial person, how do you own a part of it? I mean, you can't just walk in and say, "I'll take that corner of the office," right? Of course not. The ownership itself gets chopped up into these tiny, little, easy-to-manage pieces. And each one of those little pieces is called you guessed it, a share. It's literally your share of the pie. When you buy one, you're putting your money into the company's pot. It's capital. And in exchange, you get a little piece of the ownership. That gives you a claim on what the company owns and, if all goes well, a slice of its future profits. All right, but hold on. Not all shares are the same. You've got two main flavors: equity shares and preference shares. The easy way to think about it is that preference shareholders are like the VIPs at a club. They're first in line. They get their dividends, their slice of the profits paid out first, usually at a fixed rate. And if the company, goes bust, they're the first to get their original money back. Equity shareholders, they're the true owners, the risk takers. They're at the back of the line for getting paid. But, and this is a big but, if the company does incredibly well, their potential reward is huge. It's the classic high-risk, high-reward deal. Okay, now we're getting to the real meat of it. To really wrap your head around all the different types of capital, I want you to picture a funnel. Just imagine it. At the top, it's super wide. That's all the potential money. And as we go down, it gets narrower and narrower until we get to the actual cash the company can spend. Let's break it down. So at the very top of our funnel, the widest point, you've got authorized capital. This is the big number. It's the absolute maximum amount of money the company is legally allowed to raise by selling shares. It's written right into their legal paperwork. Think of it as their ultimate blue sky fundraising goal, the ceiling. Okay, let's move one step down the funnel. A company almost never tries to raise all that authorized capital at once. That'd be crazy. So they issue a smaller chunk of it. That's our next level, issued capital. This is the part of the big authorized pie that the company actually puts on the table and offers to investors. It's them saying, "All right, everyone, we're raising funds and this is how much we're trying to get right now." Now, our funnel gets a little narrower again. Just because you throw a party doesn't mean everyone shows up, right? Same idea here. The company issues the capital, but the subscribed capital is what people actually sign up for. It's the amount investors say, "Yes, I want in." This number is a huge tell for how excited the market is. If they get fully subscribed, well, that's a fantastic sign. We're getting further down the funnel, so people have subscribed. They've promised to buy the shares. But the company might not need all that money on day one, so it only asks for a piece of it. This is called called-up capital. Let's say a share has a face value of 10 rupees. The company might say, "Okay, just give us 7 rupees for now." They've called up 7 rupees. That other 3 rupees, that's a promise they can call on later when they need more cash. And here we are at the very bottom, the most important part of the funnel, paid up capital. This is the money that's actually in the bank. It's the real deal.
See, sometimes a company calls up the money, but an investor doesn't, pay up. That's called calls in arrears. So you take the called up amount, subtract the money that never showed up, and what's left is the paid up capital. This is the cash the company can actually use to pay salaries, build factories, and grow the business.
Okay, let's make this super concrete with an example. Meet Sunrise Company Ltd. Look at their numbers. At the top of their funnel, they're authorized to raise up to 40 lakh, big number. They decided to issue half of that, 20 lakh. And guess what? The public subscribed to every last bit of it, which is awesome for them. Then they called up 16 lakh of that. But you see that little calls in arrears line? Someone didn't pay 6,000. So the actual cash that hit their bank account, their paid up capital, is 15 lakh 94,000. See how the funnel works, from 40 lakh all the way down to the real cash. So that's the structure of the capital. But how does the process of actually getting that money work? How do shares go from the company to the public? It's basically a three-step dance. Step one is the prospectus. This is basically the company's big advertisement. It's a document that says, hey world, we'd like you to invest in us, and here's everything you need to know about our business. Step two, you, the potential investor, read it, get excited, and send in an application with some money to prove you're serious. And finally, step three is the allotment. The company goes through all the applications and decides who gets how many shares. If you get an allotment, that's it. You're officially a part owner, a shareholder.
Okay, I know that was a lot of definitions. Authorized, issued, subscribed. So let's zoom out. Why should you care? What does all of this actually mean for you? Whether you're looking to invest, or you work for a company, or you're just curious about how business works.
It matters because this capital funnel, it tells a story. It really does. That authorized capital, that's the company's dream, its ambition for growth. The subscribed capital, that's the market's reaction, a vote of confidence from the public. And that paid up capital, that's the reality. That's the actual fuel in the tank for the journey ahead. When you understand this, you're not just looking at numbers, you're reading the financial story of a business. So now you've got the tools. You've unlocked a new way to look at any company out there. You can look right past the fancy marketing and read the real story that's hidden in its capital structure. So my question to you is, the next time you look at a company's financials, what story are you